Property tax affects every single property owner, yet it is the most misunderstood tax in real estate. When your property appreciates, do you pay more property tax? Which price is property tax calculated from? The purchase price or the market price? When you purchase a new unit, do you pay more property tax than a 10-year-old unit? I'm going to share with you the 3 biggest myths on property tax. Of course, I know you like to see some real-life examples other than just theories. So, we are going to look at some real numbers in the city of Toronto. Buildings that are new versus a few years old versus 20 years old. What's the difference in their property taxes? Myth number 1. When property prices go up, the city gets more property taxes. When you earn more salary, when your business makes more sales, you pay more taxes, right? When you earn more, so does the government. So it is very natural to think that when property prices go up, the city will get more property taxes. But that's actually wrong. You see, the problem with income tax and sales tax is that they are unpredictable. When the economy grows, the government gets more revenue. And when the economy shrinks, the government gets less. The city needs a reliable and stable source of revenue to ensure that the basic needs of a city are being serviced. We can't just shut down a few police stations because the city doesn't have enough revenue that year, right? So, property tax is calculated backwards. First, the city comes out with the amount that it needs to service the city. Let's just say the city has 3 houses and it needs $11,000 a year to provide services to the residents. The houses are $500,000, $700,000, and $1 million. So in order to collect $11,000 property tax, the tax rate would be 0.5%. Now, all 3 houses appreciate 10% in value, but the city's expenses stay at $11,000. So the tax rate would actually decrease to around 0.45%. You see, the city doesn't really care what the property value is. It figures out the amounts that it needs and it adjusts the tax rate to get it. This is how the city guarantees a stable and predictable income from property taxes. Now, the question is, which price does the city use for the property tax calculation? Myth number 2. Property tax is based on purchase price. This is a very popular but incorrect perception. Property tax is actually calculated from the assessed value of your property. MPAC, Municipal Property Assessment Corporation, assess your property value every 4 years. This year, 2020, is an assessment year. So 2024 will be the next time they do an assessment. There are 5 major factors that determine approximately 85% of your property value. They are location, lot dimensions, living area, age of property, and quality of construction. Let's say you receive your assessment this year and your property value increased $200,000 from 2016. This increase will be divided over the next 4 years, meaning that your assessment value will increase $50,000 per year. What if the assessed value of your property decreased? It will be reflected immediately. Myth number 3. New units pay more property tax than old units? This would be best explained with real data. Let's do some comparisons with properties at around the same location, with the same market value, but a different age. Is there any difference in the assessed values? Case study number 1. 2 units along the Bay Street corridor in the heart of Toronto, downtown. Both were sold at exactly the same price of $668,000 in February. One was built more than 20 years ago, in 1999. The other one is just 4 years old. The assessed value of the old building is $388,000. You see, the assessed value is much lower than the actual market value. What about the 4-year-old building? The assessed value is $370,000. The current property tax rate in the city of Toronto is around 0.6%. As you know, property tax is calculated based on the assessed value. So both units pay the same property tax. Case study number 2. This time, we are going to compare an almost brand new unit with a 10-year-old unit. Both units are on Church Street around the Ryerson neighborhood. They were both sold near the end of last year at around $650,000. The assessed value of the 10-year-old unit was $407,000. The market value of the new unit was $6,000 cheaper. What do you think the assessed value is? It is $8,000 cheaper. So the assessment is pretty accurate on the relative values of the units, although they are way below the market values. Case study number 3. This one is very interesting because you will see the assessed value is way off. These 2 units both have direct access to the Union Station. One is 10 years old and the other is 2 years old. Both were sold early this year at close to $1 million. The assessed value of the 10-year-old unit is $669,000, but the assessed value of the 2-year-old unit is only $527,000. Because of this big difference in assessed values, the 2-year-old unit is actually paying $850 less property tax than the 10-year-old unit. I think the key difference in assessed value is because the 10-year-old unit is over 1,100 square feet and the 2-year-old unit is just under 800 square feet. So why would they have the same market value then? I would say there are 3 things that buyer weigh heavily on, but the assessment may not. Number 1, the layout. The 2-year-old unit has a 3-bedroom rectangular layout. The 10-year-old unit is much bigger, but it is only a 2+10 layout that's triangular in shape. And the den is really only just enough to fit a desk. Number 2, the condo fee. The condo fee of the 10-year-old unit is 40% higher because it is 40% bigger. But it is hard to make effective use of the extra space because of the layout. Number 3, modern design and amenities. In general, people are willing to pay more for the experience, like a grand lobby, a spa-like swimming pool, and a gym. You see, the assessed value is determined by a set of fixed rules, but the market value is driven by market demand and desire. The assessed value is just used to determine the property tax and doesn't affect the market value of your property. So we have just talked about the property tax in the city of Toronto. What about in cities like Richmond Hill, Markham? Do they pay more or less? You'll be surprised. With the budget of a condo in downtown Toronto, would you be able to buy a townhouse or a house in Markham? Comments below and let me know if you want future episodes on these topics. Subscribe and hit the bell so you won't miss these interesting topics.